All right, good afternoon. Check, check, radio check. I want to thank everybody for taking time out of their week to spend a little time to get caught up what's going on in the marketplace, the data that we're seeing and looking at. I continue to try and bring you value every week. It's such a unique time in history. It's a very volatile time. And some of the decisions that we make can help protect our assets as we head into retirement. So that being said, it's a moving target, and there's a lot of information to cover, and I've been doing a sort of a small introductory, just strategy or just investment logic, helping folks that are on this call to understand the landscape that they're in. And so, for the last couple of weeks, we've had some guest speakers on. We've talked about some alternatives to bonds. And we've also, started a 4-week series, which was supposed to be this week, week number 3, which is on bond yield. But because every month I've been talking about, every month I do a follow up of, the previous month. If I didn't do it this week, the data becomes almost non-important. So I've delayed, the conversations I promise to get into the milk cow next week. And then the following week, we'll have tornado watch and tornado warning and another strategy that we've uncovered that I think you'll find interesting. We also have a group of advisors that join us on these calls, and quite often their clients might be on here from across the country. And we're all like-minded in our approach. We work well together and we help each other. And, that includes their clients as well. So sit back and relax, allow us to share some of the data that we've seen for the month of March. And, although we're 2 weeks into April, some of the signals that sort of you can sort of play Monday day quarterback and say, that turned out to be accurate. So if you recall, this monthly update is broken down into 2 segments: an equity segment and an income segment. The equity segment for the month of March, you see this squiggly pattern here, consists of some different ETFs, index, sort of a pulse check of different equity stocks, as we talked about a couple of weeks ago, a basket of stocks that are sort of from different environments. So the scale across the top tells you what the colored lines index is representing. So the S&P is red, the Russell 2000, which is small caps, that is blue. And then you have, developed countries, which is that neon green iShare. You have purple, which is developing countries, and internationals, emerging markets. So typically I sort of associate that with China as a large part. Commodities, right, which is typically heavily in the past, this index is heavily laden with oils and oils futures. Real estate, right, REITs and things of that nature, and then spiders for gold, right? So it's not actual gold, but the index to sort of measure gold. So as we look at this from left to right, from the end of February to the end of March, you can see that overall equities have done okay on a 1 month basis, right? That most of these indices are above the 0%. Obviously, though, this sort of represents the sort of lack of conviction in the marketplace on where to be. Whereas if you recall last year, there were some definite trend leaders. On a month-to-month basis, it looks like people were looking at real estate again, and people were looking at betting on America with the S&P 500. And then emerging markets, as COVID starts to relieve itself, I think there's a sense of relief as in the month of March as the vaccines roll out. For those of you that don't know, I've gotten my second dose, and I can tell you it's a huge relief for me personally. My wife has not gotten it. The girls have not gotten it yet. But overall, I do sense a optimistic attitude in and about my travels. So that was positive. Now, as we look at year to date, so the beginning of January to the end of March, all the indices seem to be moving in an upward trend, and, leading the pack is commodities, right? So oil has been punished, but now restrictions are being lifted, economies seem to be opening up, people are looking to travel again. that that obviously means that the usage of fuel will be required. So it led the pack, or is leading the pack for the year. Not far behind is small caps. So businesses with the relief package, I think that's helped the American population. Again, the government is trying everything that they know to put money back into the economy. The Fed has come back and is trying to keep interest rates, the overnight rate, borrowing rate, as close to zero as possible. And all of these things are stimuluses, which is why we're seeing the market wanting to continue to move in an upward trend. And all the signals that we're seeing right now seems that bar something unexpected seems to be a continued direction. So right on down real estate, so why real estate? And real estate is one of those funny ones because I've talked to a couple people just from my own observations. Housing markets are just, houses are getting put on the market and snapped up. People are putting their houses on the market in a short amount of time, getting multiple offers and quite often quite over their asking price. Well, why I think this index has been attractive is because real estate has been a very volatile index, but I think there's been a very short supply of inventory, and there will continue to be. Pricing of the underlying assets, for at least in the residential environment, seems to be going up. Now, is that true for commercial? I have a friend of mine that owns a hedge fund that he's over in New York, and he's been looking for property for a long time. He finally found a building in Long Island and he purchased it and paid cash for it. What he told me that I found interesting is that banks are not lending money on a lot of these strip malls and commercial buildings because quite often people don't have the cash to pay for them, and you can't use the cash flow from tenants as a part of the negotiation deal to purchase the real estate because the tenants aren't keeping their leases. So I think that's a interesting marketplace. I think we'll see continued volatility in the real estate arena, and you have to separate out commercial versus residential. Again, as we look at the S&P, just it's continuing. Your blue chips, your steady eddies, technologies make up a large portion of the top five, right? The alphabets, your Facebooks, your Amazons, your Netflix, your Googles. I'm very happy. I mean, we just broke all-time highs today. But as it relates to March, that's sort of an indicator that this seems to be an upward trend. And then emerging markets and developed countries coming around 4 and 3%. But the laggard of the group is gold. And so gold, where it was the place to be last year, a flight to safety. Obviously, if you stayed there, the underlying values of the assets are starting to decline. And so this just shows you and sort of reinforces what we have suspected, is that the market seems to be on an upward trend, and the signals continue to show that. If you're not familiar with this bull bear indicator, there's a lot going on here. There's the top. I'm going to point out some arrows. So this indicator up top is called the RSI, which is a relative strength index. It's a momentum calculator. And then in the middle, we have a moving average, which just shows that when one underlying moving average crosses over a longer term moving average, that will create a signal. And then you have the MACD, which is a moving average convergence divergence. And that's also a momentum indicator. But the way that this works and the way to interpret this is there's some lines here. So there's different color lines that run from top to bottom. Right, so vertically we have red here all the way to the left, and then green. So this was 2000s, right? That was the internet bubble burst. So the signals, what has to happen is all three of these have to trip to say, hey, the market seems to be pointing that we're heading in a downward trajectory. But here was a green line, right? And this is after the internet bubble burst seemed to say, hey, everything is sort of reset and it looks like we're on an upward trend. And both of these indicators these signals seem to be accurate, hindsight being 2020. And that just goes to show it's not perfect, right? It's not to rest our hat on, but it's just, it's sort of the same thing as, licking your finger and being outside and testing the direction of the wind, right? You get a good idea what direction a storm may be coming from, or if you want to put your back to the wind, right? It's another analogy. But then there's head fakes, right? So you can see here in 2006, 2007, a very short sell, but then it turned positive and it continued up until a negative trend, which was a housing bubble burst. And then eventually that signal for a very long period of time was an upward trend. We get all the way out here to the right-hand side, and we have the last bar is a green bar. All signals are positive and seem to be so in the near future. So, as I look at data, and I know I've issued caution before, and I want to sort of, I don't have a crystal ball, right? So when I make recommendations, suggestions, part of what I want you to sort of keep in the back of your mind is it's based on the information that as I interpret it, as the trading desk, the investment teams, the people that I run circles with, as I collect data, I'm sharing with you what we see. Now, I'm very comfortable in saying, hey, listen, it seems like we've made the correct investment advice, saying that the equities components seem to be on an upward trend. And if you think about asset allocation that I talked about last week, right? If we're maybe younger and in 30s and 40s, we could probably afford a 70-30, 70% equities, 30% bond portfolio as it relates traditionally to asset allocation and diversification. As we approach retirement, we get into our 50s, right? Maybe 60s, we might be at a 60-40 blend. And then eventually we start to think about traditional wisdom, which is, hey, we're about ready to retire. Maybe we should dial back some of the equity risk to a 50-50 portfolio. And although that has been investment theory heading into the future, I'm perfectly comfortable on the equity side, making the 50% or 60% equity recommendation. Where I have a lot of concern, and I've been talking about now for years, is the bond component, right? So the bonds is the debt side of it, this wisdom that equities are safe. And you're going to see next week when I talk about the income cows, some supporting data to help show you what I see, my concern of having these traditional portfolios. And that's why you've heard me talk about having strategies in place that are, for lack of a better term, a bond alternative. And we will start to talk about that more in the future. So as we look at the month of March for income type generating assets, so from left to right on the top of the slide, we see with the red is U.S. aggregate bond portfolios, the blue is high yield corporate bonds, right, U.S. Then we get into the 7 to 10 year treasuries, right? So these are 10 T-bonds, right, or T-bills if they're shorter than that. We have Vanguard, your internationals, right? So again, those are your emerging markets and things of that nature, your total international bonds. So this could be corporate, this could be Europe, this could be emerging markets. That light blue is where everybody went to last year, which is that 20-year treasury. That was that flight to safety, led the pack last year because everybody was nervous that the sky was falling. And so as a safety mechanism, they went to gold and they went to treasury bonds, right? 20-year plus or shorter terms. Now you have the muni bonds, and then, which are typically your more traditional, and then your high yield muni bonds. So as we look at the colors, right, we can see that the high yield munis, look at the top performers for the month, a little over 1%. Remember what I've been talking about is everybody is looking for yield right now. And the bond portfolios, because the Fed is holding rates, because inflation hasn't reared its head, right? People are starving for milk cows, right? And we need to figure out ways to generate this income. And it's interesting because, again, I listen to a lot of, I think, very wise folks over the years and have been sharing these observations. What I'm finding interesting is now it's becoming more commonplace and mainstream. Your talking heads or some of the webinars or go to meetings that I'm invited to. I was just on one yesterday talking about this exact same issue that I've been talking about for several years now. It's not that I'm any smarter, but I think it's now starting to become recognized. Hey, folks, we got a problem. So as we look at the year to date, this is the problem on, from a macro level year to date. Now it's only a 3-month snapshot, but you'll see next week when I do the milk cow conversation and I start to show a 50-year snapshot of bond portfolios, you'll start to see exactly this, like we're at this all-time bottom. So if this is the case, right, and right now you're looking at high yield muni bonds, right, at 1.5%, and then you got the high yield corporate bonds. People are starved for yield. Everything is lost money, right? So that in and of itself is problematic. And then when you add the three wise men, right, which is again the relative strength index, the moving average, and then the MACD, two of these indicators have crossed over, the moving average and the MACD, right? So the last line here is green, right? We've been on this bull run, but you can see that crossover right there, and you can see this crossover here. The only one that has not triggered is the relative strength index, and we suspect that should happen here probably in May. If that happens, a red line. And what does that mean? It doesn't mean the sky's falling. It just means that again, the bond portfolios that you're currently holding, remember, you'll get your money back if you hold it to maturity. But most people hold bond funds. They don't actually own the bond. Therefore, they don't have that decision to say, hey, don't sell my bond, right? Hold on to it so I don't lose any principal. And that's why you will see declines in bond values. So this is a proprietary index that Formulafolios put together quite a few years ago, but it's called the Recession Probability Analytics, and it uses a bunch of metrics, right? I'll say probably close to 30 or 40 metrics, and it's scaled on 0 to 100. 0 meaning that, hey, you know what? You're extra lucky. You have the Midas touch. Go to Atlantic City, bet everything on red because it's gonna hit. Right? That means that if the line in the middle, 50, if we're below the line, that is a bullish signal that the market seems to be on an upward trend, or we have clear skies ahead. It's actually down from the month before. So from February, which is a good sign, right? But if it does get above that, as it did last year, right, that, there was concern in the marketplace, but it's slowly, as vaccines, as the government stepped in and offered relief packages, that all these things took the economy in a positive direction and seem to be working for the near future. So this is our overall review of the month of March. Signs seem to be good. Here we are in April, and things seem to be continuing. I will continue to bring you this data on a monthly basis with every week new content. I have some topics that have been suggested to me that I will start to build out as well. But we have 2 more weeks of my 4-part series, right? So we have the milk cow, which will be next week. And then we have the tornado warning or tornado watch. So think about it like this. We found a strategy that we have access to. I'm here in New Jersey. I'm going to use flood warning. If you have a house down the shore, you have to have flood insurance all the time. And that makes owning a house near the ocean very expensive. Well, we insure most of the assets that we have that we consider valuable. But what we don't tend to do, because we're not quite certain how, is to have insurance on our portfolio. Now, maybe it's not the best term because it's not technically insurance, but it does help you to get the picture. And that's what tornado watch is. What happens is we don't have the insurance or the protection on an index or portfolio all the time. So if there's volatility of down 5% or 10%, most people can stomach that. But what's happened is they've created signals using the VIX, and I'm going to actually ask these guys to be on the call with us when I do that call. I haven't asked them yet, so stay tuned. But what it basically says is as these indicators start to say, hey, this is actually now a flood, we see a tsunami coming. Well, how cool would it be to be able to say, you know what, I see the tsunami, I want to protect my house 100%, even though it's a short-term event, we want to protect the asset. And that's what's possible with some of the technology and strategy that they put in place. And again, it's not supposed to be all or nothing. Think of that again as a satellite, as I've talked about in the past. So, I want to thank each and every one of you again for taking time to be in on the call each and every week. If I can help you in any way, you have any questions, please reach out. I'm here. I'm a phone call away. Hopefully I'm continuing to bring you value and not waste your time. And then again, if you have questions or if you know people that could use some direction, from a professional, that's what I do. So please feel free to point them in my direction. Everybody have a great day. Stay safe. And if you need me, call me. Bye-bye.